Why fear creates mispriced assets. There is a moment in every market cycle when the crowd becomes the price, not the fundamentals, not the earnings, not the underlying value of the thing itself. Just the crowd, just the fear inside the crowd. And when that happens, when human emotion becomes the dominant force setting prices, the most dangerous thing you can do is agree with everyone around you. I have watched this happen more times than I can count. And every single time, the pattern is the same. Something frightens people, something they did not expect, did not plan for, did not build into their models. And they run. They sell. They talk loudly about how everything is falling apart. And in their running, in their panic, in their loud public declarations that the world is ending, they leave behind something extraordinary. They leave behind price. Real price, honest price. The kind of price that only appears when fear has driven away everyone who is supposed to be rational. That is where I have spent most of my life. Not chasing momentum, not following the crowd into whatever is exciting and loud and moving fast. I have spent my life waiting at the edge of the forest, quietly, patiently, watching the frightened animals run past me in the other direction. And then, when the forest goes silent, I walk in. This is not a strategy I invented. It is a strategy I observed. In nature, in markets, in human beings, fear creates mispriced assets. Not occasionally, not by accident, reliably, consistently. As dependably as winter follows summer and silence follows panic. The question is whether you have the temperament to take advantage of it. Most people do not. And that is not an insult. It is simply the truth about how human beings are wired. We are not built for long-term thinking. We are built for survival. And survival thinking is short-term by definition. When something threatens us, we respond immediately. We do not sit and calculate intrinsic value while the building appears to be on fire. We run. The markets know this. The markets have always known this. And the people who understand this fact, who truly internalize it not just intellectually, but in their bones, in their behavior, in the decisions they make, when everyone around them is losing their composure, those are the people who accumulate real wealth over time. Not the analysts, not the forecasters, not the people on television explaining with great confidence exactly what is about to happen next. The quiet ones, the ones who are never on television, the ones who are reading when others are talking, the ones who are buying when others are selling and selling when others are buying, and mostly just sitting still when everyone else is moving. I want to talk about fear today, not because it is an interesting academic subject, but because fear is the single most powerful pricing mechanism in financial markets, and almost nobody treats it that way. They treat fear as an obstacle. I have always treated it as information. When I see fear in a market, I do not see danger first. I see signal. I see the possibility that something is being valued not by what it is worth, but by how frightened the people who own it have become. And frightened people price things incorrectly. They always have. They always will. This is not a character flaw. It is a feature of the human condition. We attach price to emotion. We attach price to narrative. We attach price to what happened yesterday and what we believe will happen tomorrow. And both of those things are far less reliable as pricing mechanisms than the actual underlying value of the asset sitting in front of us. I learned this early, not from a textbook, from watching people. I grew up in a time when the economy moved through cycles that most people today have never personally experienced. And in those cycles, I watched very intelligent, very educated, very capable people make enormous financial mistakes. Not because they lacked information, but because the information they had was filtered through fear, and fear changed what they saw. They saw collapse where others saw correction. They saw permanent loss where others saw temporary disruption. They saw the end of something when in reality they were simply standing in the middle of it. That gap, the gap between what fear makes you see and what is actually there, that is where wealth is made. Not quickly, not loudly, not in ways that make for exciting dinner conversation, quietly, slowly, with a patience that most people mistake for passivity. Let me tell you something about patience that took me a long time to fully understand. Patience is not waiting. Passive waiting is what most people think patience means. sitting still, doing nothing, hoping that things improve. That is not patience. That is abdication. Real patience is active. Real patience is the discipline to hold your position while everything around you is screaming that you are wrong. Real patience is continuing to trust your analysis when the market is saying your analysis is worthless. Real patience is the ability to absorb short-term pain without changing your long-term thinking. That is extraordinarily difficult. Not because the math is hard. The math is almost never the hard part. The hard part is the noise. The relentless, constant, overwhelming noise of other people's opinions, other people's fear, other people's certainty that they understand something you do not. I have sat through periods where the market told me every single day for months that I was wrong. And during those periods, the discipline required to stay still, to not react, to not validate my discomfort by making a move just to feel like I was doing something, that discipline was the most valuable thing I possessed. More valuable than any analysis, more valuable than any information, more valuable than any relationship or any advantage. The discipline to do nothing when everything in you wants to do something. That is the foundation. Now let me talk about the specific way fear creates pricing errors, because I think this is misunderstood even by people who consider themselves sophisticated investors. Most people think of fear-driven mispricing as a sudden event, a crash, a crisis, a moment when everything falls at once and the obvious thing to do is buy. But that is only one form of it, and actually, it is the easiest form to recognize. When everything is falling at once and the headlines are all catastrophe and everyone you know is talking about how they are losing money, the signal is relatively clear. The harder skill, the rarer skill, is recognizing mispricing when it is not obvious. When fear is quiet instead of loud. When an asset is not falling dramatically but is simply being ignored, being underestimated, being priced by people who have decided, for reasons that have nothing to do with the underlying value, that this particular thing is not worth their attention right now. That kind of mispricing is harder to see. It requires you to think differently from the consensus, not just in a moment of crisis, but in ordinary times. To look at something everyone has dismissed and ask seriously whether they are right or whether they are simply reflecting the current mood of the market, because the market has moods. Make no mistake about that. The market is not a calculating machine. It is a collection of human beings making decisions, and human beings bring their emotions to every decision they make, whether they acknowledge it or not. The professional investor who tells you they make purely rational decisions is either fooling you or fooling themselves. Emotion is present in every trade. The question is whether you are aware of your emotions and managing them, or whether you are simply letting them drive while you pretend to be in control. I have always tried to be aware. I have not always succeeded, but I have tried. And what I have found over decades of paying attention to my own psychology as closely as I pay attention to the markets is that the most dangerous emotional state for an investor is not panic. Panic is visible. Panic announces itself. Panic is uncomfortable enough that you notice it and can attempt to correct for it. The most dangerous emotional state is comfort. Comfort is invisible. Comfort feels like confidence. Comfort feels like clarity. Comfort feels like you have finally figured out the pattern and you understand what is happening and you can relax because everything makes sense. And that feeling, that specific feeling of comfortable certainty has preceded more investment mistakes in my observation than any amount of panic has. Because panic makes you sell at the wrong time. But comfort makes you hold at the wrong time and buy at the wrong time and ignore warning signs and dismiss the people who are telling you that something does not add up. The great bubbles in history were not built on panic. They were built on comfort, on the widespread, deeply felt belief that this time things were different, that the old rules did not apply, that the prices being paid were not the result of euphoria, but of genuine recognition that something fundamentally new was happening. I have lived through several of those moments, and each time, the thing that struck me most was not the scale of the eventual collapse. It was how intelligent the people caught up in it were. These were not naive people. These were not uneducated people. These were analysts and fund managers and business leaders who had spent their careers thinking carefully about markets and value and risk, and they were as caught up in it as anyone. Because that is what comfort does. It is not selective about its victims. The lesson I took from watching this repeatedly is that the correct response to feeling certain is skepticism. Not toward the market, toward yourself. When you feel most confident, that is precisely the moment to slow down and ask whether your confidence is based on evidence or on the simple fact that everything around you seems to confirm what you already believe. Confirmation is comfortable. Contradiction is useful. Seek the contradiction. Spend time with the people who disagree with you. Read the arguments against your position with more care than you read the arguments in support of it. Force yourself to steelman the opposing view, to make it as strong as it can possibly be, and then ask whether you can genuinely defeat it or whether you are simply more emotionally attached to your own position. This is not natural. This is not how human beings are wired. We are wired to seek confirmation. We are wired to surround ourselves with people who agree with us and information that supports what we already think. This is true in life, and it is especially true in investing, where the financial stakes make the ego stakes even higher. Nobody wants to be wrong with money, and that unwillingness to be wrong, that deep psychological resistance to the idea that your analysis might be flawed, is one of the most reliable sources of mispricing in the market. Because when enough people become too attached to a particular view of the world, they will hold on to that view, even when the evidence begins to shift. They will rationalize. They will explain away contradicting data. They will attribute their discomfort to noise rather than signal. And slowly, quietly, the gap grows between where prices are and where they should be, until it cannot be ignored any longer. And then fear arrives, and with fear comes the mispricing that rewards the people who were paying attention. I want to tell you something now that I believe is one of the most important things I have ever learned about wealth. Wealth is a byproduct of thinking correctly over long periods of time. Not of being smart, not of being connected, not of being lucky, though luck is always a factor, and anyone who tells you otherwise is being dishonest about the role of randomness in outcomes. But primarily, wealth is the accumulated result of making more good decisions than bad ones, over a long enough time period that the compounding of those good decisions produces an outcome that looks, to someone observing from the outside, like genius or like fortune. It is neither. It is discipline applied consistently over time. And discipline, real discipline, the kind that holds in the face of fear and comfort and noise and the opinions of people whose approval you value, that discipline has a foundation. The foundation is not willpower. Willpower is exhaustible. Willpower is a resource that depletes with use. Anyone who has tried to sustain a behavior purely through willpower knows that eventually the willpower runs out, and when it does, the behavior collapses. The foundation of real discipline is clarity. Clarity about what you believe. Clarity about why you believe it. Clarity about what evidence would cause you to change your belief and what evidence is simply noise that should be ignored. When you have that clarity, discipline becomes easier. Not easy. Nothing about this is easy. But easier because you are not fighting uncertainty every moment. You have a framework. You have a set of principles that govern your behavior so that when fear arrives or comfort arrives or the opinions of people you respect push against your position, you do not have to decide in the moment how to respond. You already know. Your framework has already decided for you. This is why I have always invested significant effort in developing principles before I need them. Not in the moment of crisis, when emotion is high and time is short and clarity is hardest to find, but in the quiet periods, in the calm between cycles. When I can think clearly and honestly about what I believe and why and under what circumstances I would change my mind. Those principles become the structure that holds when everything else is shaking. Let me talk now about a specific kind of mispricing that I find particularly interesting and particularly reliable as a source of opportunity. The mispricing that comes not from crisis or panic but from neglect. There are always assets in any market environment that are being ignored, not hated, not feared, simply overlooked. They do not fit the current narrative. They do not have the characteristics that excite people right now. They are not growing fast enough, or disrupting enough, or telling a compelling enough story. And so, they sit. Priced by the few people who still pay attention to them, which means priced by the least excited, least optimistic subset of potential buyers. And that consistently underprices them relative to what they are actually worth. These are my favorite opportunities, not because they produce the most dramatic returns, they rarely do, but because they require the least amount of luck. You do not need the market to change its mood to do well in a neglected asset. You simply need the underlying fundamentals to continue to be what they are. You need the business to keep producing. You need the asset to keep generating. And over time, often a long time, the gap between price and value closes. Not because something exciting happened, because eventually in every market, things revert to their fundamental value. That reversion is not dramatic. It does not make headlines. Nobody rings a bell when neglected assets quietly return to fair value. But the return, compounded over years, is often extraordinary. The investor who bought when nobody was looking, when the story was boring, when there was no momentum and no excitement and no social proof that this was a smart thing to do, that investor collects the reward that the excited crowd will never have the patience to earn. Patience again. Always patience. I want to be honest about something, because I think honesty here is more useful than the kind of confidence that makes for better stories. I have been wrong. Many times. Not most of the time, but enough times, in enough significant situations, that the experience of being wrong is familiar to me. And what I have learned from being wrong, from sitting with positions that were not working and trying to understand why they were not working and whether I should change my mind or hold my conviction, is this. The most valuable thing you can do when you are wrong is understand precisely why you were wrong, not in general terms, not in the way that allows you to preserve your ego while nominally acknowledging the mistake. In precise terms. Was the underlying analysis wrong? Was the timing wrong? Was the thesis correct, but the vehicle wrong? Did you understand the business but misjudge the management? Did you understand the value but misread the timeline? Each of those is a different kind of mistake, and each requires a different kind of correction. Most people, when they are wrong, focus on the outcome. The loss, the price movement, the gap between where they thought things would go and where they actually went. I focus on the reasoning, because the outcome is history. You cannot change it, but the reasoning is where the lesson lives, and the lesson, if you extract it correctly and apply it going forward, is worth far more than whatever you lost. This is not consolation. This is not the kind of thing you say to make yourself feel better about a mistake. This is strategic. The investor who learns more from losses than from wins will, over a long enough time horizon, outperform the investor who learns primarily from wins. Because wins often teach you nothing except confidence. And confidence, as I said earlier, is the most dangerous emotional state. Losses, if you approach them correctly, teach you everything. They teach you where your model of reality diverges from reality itself. They teach you where your assumptions were untested. They teach you where your conviction was based on hope rather than evidence. Those are precise, valuable, actionable lessons. If you are willing to look at them clearly. Most people are not. Most people explain their losses in ways that protect their ego. It was bad luck. The market was irrational. The timing was wrong, but the thesis was right. Everyone made mistakes in that environment. All of those things may be partially true, but they are not fully true. And the part that is not true, the part that your explanation is quietly excluding because it is uncomfortable, that is the part that matters. Find that part. Sit with it. Do not move on from it until you understand it clearly enough to explain it to someone else in simple language. That is how mistakes become assets. Let me talk now about the psychology of the other side of the trade. When fear creates mispriced assets, there is someone on the other side of every transaction. Someone selling. And understanding the psychology of that seller is, I think, one of the most underappreciated skills in investing. Why are they selling? That seems like a simple question, but the answer is almost never simple. Sometimes they are selling because they need liquidity. They have obligations that require cash, and the asset they are holding is the one they can most easily convert. In that case, the price they accept has nothing to do with their view of the asset's value. It is a forced transaction, and forced transactions are almost always mispriced in favor of the buyer. Sometimes they are selling because they are frightened. The price has fallen, and they cannot tolerate the uncertainty of not knowing how far it will fall. They need the discomfort to stop. They need to take the loss and move on, and stop watching the number go down. And they will accept almost any price to achieve that psychological relief. Sometimes they are selling because of social pressure. The people around them have sold. The consensus view has shifted. Holding the position now requires defending it, and defending it is exhausting and isolating, and they would rather be wrong with everyone else than right alone. And sometimes, rarely but significantly, they are selling because they know something you do not. Because they have information or insight that genuinely justifies the price they are accepting. The skill is in distinguishing between these cases. The first three are sources of opportunity. The fourth is a warning. And the only way to distinguish them reliably is to do the work. Not the work of following the market. Not the work of reading what everyone else is reading and forming the same conclusions. The actual work of understanding the specific asset, the specific business, the specific circumstances well enough that you can make an independent judgment about what it is worth. Independent judgment is the foundation of everything, not contrarianism for its own sake. Contrarianism without independent judgment is just a different form of following the crowd of people who think the crowd is wrong. Independent judgment means genuinely not caring what the consensus is, not being proud of disagreeing with it, not being afraid of agreeing with it, simply following your own analysis wherever it leads and being willing to act on that analysis even when acting on it is uncomfortable. That discomfort is the price of entry. If the right move were comfortable, everyone would make it. The reason mispriced assets exist is precisely because the right move is uncomfortable. Because buying something that everyone around you believes is falling requires a level of psychological independence that most people cannot sustain. The discomfort is not a signal that you are wrong. The discomfort is a signal that you might be right. Think about that carefully. In a world where most people are being driven by emotion, where fear is creating prices that do not reflect fundamental value, being emotionally steady is itself an edge. Not a small edge, a significant, durable, structural edge that does not erode over time the way information edges do. Information edges are temporary. The market absorbs information quickly. What was a genuine informational advantage yesterday is priced in tomorrow. Behavioral edges are permanent. Human beings will always be human beings. Fear will always drive people to sell at the wrong time. Comfort will always drive people to hold too long. Envy will always drive people to chase what has already appreciated. These patterns are as old as markets, and they will not change because they are not the result of ignorance. They are the result of the fundamental architecture of human psychology. And the investor who has genuinely, durably, consistently mastered their own psychology has an edge that cannot be arbitraged away. That is the real prize. Not the information, not the network, not the analysis, the mastery of self. I have spent far more time in my life working on my own thinking than on any external analysis. More time questioning my assumptions than building on them. More time deliberately seeking discomfort than seeking confirmation. Because I understood early that the market would always generate information faster than I could process it, that there would always be people with better data, better models, better access. But mastery of self is available to anyone willing to do the work. It does not require special access. It does not require superior intelligence. It requires honesty. Relentless, unflinching, sometimes painful honesty about what you know, what you do not know, what you believe, and why you believe it. That honesty, cultivated over decades, becomes the foundation on which everything else rests. And when fear arrives, as it always does in its many forms, loud and quiet, sudden and gradual, that foundation does not shake. You simply observe. You watch the price diverge from value. You wait for the gap to become large enough that the margin of safety is sufficient. And then, quietly, without announcing it, without seeking validation, without needing anyone else to agree that you are making the right move, you act. And then you wait again. That is the whole of it. Not complicated, not dramatic, not exciting in the way that people who watch markets from the outside imagine it to be. Just clarity, patience, and the willingness to be alone in your conviction for however long it takes for the world to agree with you. Some of my most profitable positions were ones I held for years before anyone else saw what I saw. Some of them I held through periods where I was being publicly criticized for holding them. Some of them required me to sit with significant unrealized losses and explain to people who trusted me why I had not sold. Those were the most uncomfortable periods of my life. They were also, in retrospect, where the most important learning happened. Not about markets, about myself. About what I actually believed versus what I thought I believed. About whether my conviction was based on genuine understanding or on stubbornness. About the difference between holding through difficulty because you have thought the situation through clearly and holding through difficulty because you cannot admit that you might be wrong. Those distinctions are subtle and they are crucial, and they can only be made with honesty. Which brings me to the thing I want to leave you with. In every market environment, in every cycle, in every period of fear or euphoria or quiet neglect, the question is always the same. What does this asset actually worth? Not what the market says it is worth. Not what people are excited about or frightened of or ignoring. What it is actually worth based on the fundamentals, based on the reasonable projection of future value, based on an honest assessment of the risks. That question, asked honestly and answered carefully, is the entire discipline. Everything else, the psychology, the patience, the behavioral mastery, all of it exists in service of that one question. Because if you can answer it correctly more often than you answer it incorrectly, and if you have the patience to wait for the market to agree with your answer, the returns will take care of themselves. They always have. They always will. Fear will continue to create mispriced assets. And the people who understand that will continue to be waiting quietly when it does. The forest does not care about the panic of the animals running through it. It simply stands, it waits, and it collects everything that fear leaves behind.